In January 2000, a sock puppet appeared on the Super Bowl in front of 88 million viewers, promoting a company that lost money on every single sale. 9 months later, that company was dead. Its stock had fallen from $11 to 19 cents. And the investors who believed the hype lost everything. This is the most important investing story most people have never heard. The dot-com bubble did not just wipe out a few startups. It erased $5 trillion in market value over 2 years. And the most dangerous part is not that it happened. The most dangerous part is that the warning signs were obvious to anyone who bothered to open a balance sheet. Today, I am going to walk you through exactly what happened, why millions of smart people got swept up in one of the greatest manias in financial history, and the 4 timeless lessons every investor needs to remember. Because bubbles do not stop happening. They just change costumes. To understand pets.com, you first have to understand the world that created it. In the mid-1990s, the internet went from a curiosity used by academics to a global phenomenon seemingly overnight. And Netscape's IPO in August 1995 lit the fuse. The company went public at $28 per share and doubled on its first day of trading. The founders became millionaires before lunch. That single IPO rewired Wall Street's brain. Suddenly, the formula for success was not profits, not revenue, not cash flow. It was eyeballs. Page views. Growth at any cost. Venture capital flooded into anything with a .com in the name. Between 1995 and 2000, the Nasdaq climbed from around 1,000 to over 5,000. A 5-fold increase in 5 years. The mantras of the era were intoxicating. This time it's different. The old rules don't apply. Get big fast. Wall Street analysts slapped by ratings on companies that had never earned a single dollar of profit. And if you questioned the valuations, you were called a dinosaur who just did not get it. Into this frenzy walked Pets.com, founded in 1998 with a simple pitch: buy pet supplies online instead of driving to the store. On the surface, it sounded reasonable. But the business model had a fatal flaw that anyone with a calculator could have spotted. Pet food and cat litter are heavy. Shipping a 30-pound bag of dog food cost more than the bag itself. Pets.com was literally losing money on every transaction and hoping to make it up on volume. That has never worked. Not once in the history of business. But Wall Street did not care. Amazon invested in Pets.com, taking roughly a 30% stake. Hype replaced analysis. In January 2000, Pets.com spent $1.2 million on a Super Bowl ad during Super Bowl 34 featuring its now famous sock puppet mascot. The ad was charming. 88 million Americans loved the puppet. 1 month later, in February 2000, Pets.com went public at $11 per share, raising $82.5 million. At its peak, the company carried a market capitalization of nearly $290 million. Now consider the contrast. PetSmart, the brick-and-mortar pet retailer, had over 750 stores across the country, roughly $2.1 billion in annual revenue, and was actually turning a profit. Real stores. Real customers. Real cash flow. But in the dot-com era, profitability was boring. The market wanted growth stories, not income statements. 9 months after its IPO, on November 7, 2000, Pets.com announced it was shutting down. The stock had fallen to 19 cents. 300 employees lost their jobs. The sock puppet mascot, arguably the most recognizable asset the company ever created, was later sold for around $125,000 to a pet insurance company. Investors who bought at the IPO lost over 98% of their money in less than a year. Here is what makes this story truly staggering. Pets.com was not the exception. It was the rule. Consider eToys. It went public in May 1999. On its first day of trading, the stock soared, giving the company a market capitalization of roughly $7.8 billion. At that moment, eToys, an online toy store with approximately $30 million in annual revenue, was valued higher than Toys R Us, which had $11.2 billion in revenue and over 1,500 stores worldwide. Let that comparison sink in. $30 million in revenue was worth more to Wall Street than $11 billion. eToys went bankrupt less than 2 years later, in March 2001. Webvan promised to reinvent grocery delivery. It raised $375 million in its IPO in November 1999 and reached a peak market capitalization around $4.8 billion. The company built massive automated warehouses, expanded into 8 cities simultaneously, and burned through cash at a staggering rate. By July 2001, Webvan was gone. Boo.com, an online fashion retailer, burned through more than $100 million in just 18 months before collapsing in May 2000. Kazemo.com, which promised free 1-hour delivery of snacks and DVDs, raised over $250 million and also went under in 2001. And when the music finally stopped, the devastation was unlike anything a generation of investors had seen. The Nasdaq fell 78% from its March 2000 peak of 5,048 to its October 2002 low of 1,114. $5 trillion in market value was destroyed. And the Nasdaq did not reclaim its 2000 peak until March 2015. 15 years of waiting, just to get back to even. So what do we take from all of this? These are not just historical curiosities. These are principles that can protect your wealth for the rest of your life. Lesson 1: Profits are not optional. Every bubble in history features the same delusion that some new paradigm has made profitability unnecessary. It never has. A business that cannot generate more cash than it consumes will eventually die. No amount of user growth or Super Bowl ads changes that math. Warren Buffett stayed completely out of internet stocks during the late 1990s. He was mocked for it. Barron's ran a cover story in December 1999 asking, "What's wrong, Warren?" His response was simple: he did not invest in what he did not understand, and he could not find a single internet company trading below its intrinsic value. When the crash came, Berkshire Hathaway was sitting on cash, ready to buy quality assets at bargain prices while everyone else was licking their wounds. Lesson 2: Valuation is your margin of safety. Benjamin Graham wrote that the margin of safety is always dependent on the price paid. When Pets.com went public at a valuation approaching $300 million with deep operating losses and no path to profitability, there was zero margin of safety. Any investor who had simply compared the price to the underlying economics would have walked away. Lesson 3: A great narrative is not a great investment. The internet did change everything. That was a true statement. But a true story about a trend does not make every company writing that trend a good investment. For every Amazon that survived and thrived, there were 100 Pets.coms that burned to the ground. The skill is not spotting the right trend. The skill is finding the right business, at the right price, with real economics behind it. Lesson 4: You do not need to catch every wave. You need to survive every crash. The market can stay irrational for a long time. But it cannot stay irrational forever. Every overvalued company in the dot-com era eventually returned to its true worth. If you are a disciplined investor, your greatest advantage is patience and cash. You do not have to participate in manias. You just need to be ready when the wreckage creates real opportunity. If there is one principle to carry from the dot-com bubble, it is this. Benjamin Graham said it best: in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Pets.com won the popularity contest for about 9 months. But when the weighing machine turned on, there was nothing on the scale. The companies that survived, Amazon, eBay, Google, were the ones that eventually built real businesses with real profits. Price follows value. It always has. It always will. And no sock puppet, no matter how charming, changes that. That is the story of Pets.com and the $5 trillion crash. If this helped you understand why valuation matters more than hype, subscribe to the channel. We publish a new investing lesson every single day. And drop a comment below: what company today reminds you most of the dot-com bubble? I am genuinely curious what you think. Tomorrow, we are breaking down how to actually calculate whether a stock is overvalued, so you never get caught holding the next Pets.com. I will see you then.